Welcome to. It's so funny when we're talking about feet smelling and ice plunges, and then we get cut from the green room. I sometimes wish the people who are watching could be in the green room with us when we are shooting the shit when the cameras aren't rolling, which, by the way, is not much different than when the cameras are. But anyway, really welcome to Tradier, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Thank you guys so much for joining us, by the way. This show gets a crap ton of eyeballs live. It wasn't even designed necessarily to be watched live. It's a podcast that's designed to be packaged up and put into the ether. And you guys all come and you watch us live and you give all the great feedback. We are humbled by your support. Anyway, we're about to bring in a good guest, but I have a couple questions for Bobby first. Basically, since the election, a lot of assets have rallied, particularly stocks. Most of them have stayed pretty elevated. What do you think?
Well, I think that there might be some mispricing going on. I like the optimism. The optimism is probably warranted. But as our friend James Fishback said, take Trump seriously, but not literally. We don't know what of all the promises that have been made are going to actually go through. You do know there's going to be rampant deregulation in the beginning. That's a reason to rally a little bit. We do know there's going to be an attempt at passing tax cuts on the corporate side. That will likely pass. That's another good reason to rally. But what the actual effect of tariffs, if any are levied on inflation itself, what those initial tax cuts and the spending that might follow will do to inflation, and what that does to the Fed's trajectory of rate cuts. So I think the pause we've had over the last couple of days makes a little bit of sense.
I think so too, but there's been a pause without a pullback. So that to me
suggests, without a pullback for sure.
Yeah, that suggests maybe some strength. Anyway, on to our guest. As I say a million times, you may think that Bobby and I have opinions that are wrong and that we're full of shit. And by the way, sometimes Bobby and I think we're full of shit too, and we just keep talking anyway. But you cannot deny the fact that we get great guests. Perhaps that's been being in media for 25 years, but today is not going to disappoint. We have options volatility analyst, longtime CBOE options trader, Jay Soloff. He is a wealth of knowledge on options. Let's bring him in now. Jay, so good to have you here.
Thanks, guys. Nice to be here.
But there's something that's really important right off the bat. Bobby and I are from Chicago, so we didn't get to pick our football team. We just got the Bears. Now you hold on. Let me finish this. You have a Chiefs emblem. You talk about the Chiefs a lot. Are you from Kansas City, or did you just gravitate there when they drafted Patrick Mahomes? And if the answer is the latter, I'm not sure we can be friends. Can you just pick a team?
Yeah, and it's funny to be a fan of a team that I get asked that question a lot. No, I'm from Kansas City. I born and raised.
Okay, that's fine then. Then you win.
I went to all the playoff games at Arrowhead in the 90s, all of them. I think maybe there were 3 of them, but so I was there when they had good teams, but never went anywhere. I live in Arizona now, but I raised my kids were born here, and I raised them to be Chiefs fans. So they actually started appreciating football right when the Chiefs got Mahomes. So they only know the Chiefs as this really good team, which is kind of, I'm good for them. Right. But
great. Yeah. Well, we complain a lot about being Chicago fans, but mine and Bobby's age, we got the 85 Bears when we were in college, and the 85 Bears, remember in 84, the Bulls drafted Michael Jordan, which I think for the 15 years that he played for the Bulls, like if I had to list the people who provided me hours of entertainment, Michael Jordan's about 1,000 times more than the next person. Literally during that 15-year period, we would never miss games. So Chicago fans, although it's been a drought for a while, we've had some luck over the years as well. I want to talk about,
by the way, you had the Blackhawks to that because we had 3 Stanley Cups in 6 years.
Oh yeah, how about that? That's pretty cool.
Quite a bit. That's pretty much. And Chicago is a football and hockey town. Michael Jordan changed that.
Yeah.
And now it's kind of changed back, I would argue.
Okay. I was just in your town in Arizona a couple months ago and really, really liked it. How long have you lived there? What's the history of that town? Is that downtown area pretty new, or has it been kind of cool for a long time?
Downtown
Gilbert.
Oh, you actually were in downtown Gilbert. Yeah, that's pretty new. It was pretty much a barren wasteland it's kind of funny. My wife actually went to high school out here when they were in Gilbert, when there were 1 or 2 high schools, and it was, I don't know, dirt roads, like half.
Yeah.
There was a couple main roads and there were a lot of dirt roads. And then we built out here. We got married in 2007 and built out here because it was affordable. Right. And since then it has become, it's crazy, right? Like you can't get a house here now for a reasonable amount, in my opinion. I mean, they've built up that downtown, they built up all this stuff. I mean, it's pretty insane. But yeah, I mean, we've been here for 20, I mean, I've been in Arizona for 22 years and most 17 of that in Gilbert. So I've kind of gotten lucky there.
Bobby?
Yeah, so let's talk. You and I talked last week briefly, and we talked about what you're doing now, and a lot of what you're doing now has to do with equity options. So I kind of want to dig right into it. When we look at the way the options have behaved, I called today a rally pause, right? And I look at it, and volume is okay. It's not great. It's not earth shattering, but it certainly wasn't poor volume. I want to ask you, like, when you see a move this large, that really isn't driven by anything concrete. I mean, I guess you could say that election was concrete. We know the concrete results of it, but we don't know the results of the policies on the market. How do you look at options with that sort of a lens?
And that's a great question, because I could probably go on for the rest of the show about that. But I for me, everything revolves around volatility, right? That was, as an option market maker, that was the most important thing, right? That was the one component of your option pricing model that people didn't agree on, right? So you spend all your time, back when I was on the floor, it was doing a volatility curve in Excel. Now you have, a market making firm's going to have 100 quant PhDs with the latest technology coming up with your curve, but it all comes down to this volatility, the volatility situation. And for me, the whole thing was volatility was high going into the election. Immediately after the election, because it was a concrete result with no question on who won, et cetera, volatility plunged. To me, that is a good sign for the market, right? There's obviously things to worry about. There's still going to be inflation and interest rate concerns. There's obviously concerns in the Middle East. There's stuff maybe that's why volatility, that's maybe the VIX is around 14, 15 instead of 11, 12, right? There's some stuff built into there, but it was over 20 before the election. And it significantly dropped, once the election occurred. You could see how comfortable the market was with having, I don't even think it necessarily would have mattered who won. I think they wanted a concrete winner. I think what they didn't want was uncertainty and that sort of thing, right? So, because who knows what the policies are going to be, right? And who knows how long it'll take. And even with a full Congress, that's all in one administration. Who knows if they'll actually all agree, right? So all that stuff is that, but what fiscal policy takes forever it's all monetary policy anyways, right? So what they really wanted was less uncertainty, and that's what they got. And I think that's probably good for the markets for the foreseeable future, outside of some blow up geopolitical, right?
Can I have a question about the 0 days to expiration options and the absolute explosion in the retail volume of that product? Is there a chance that all that involvement is obfuscating some of the normal volatility signals? And if so, how is it doing so? And if not, is it any sort of concern to worry about? I keep thinking that it's not. Or 1 day options, if everybody gets wiped out, a fool and his money are soon to part. What do I give a shit? What am I missing in that?
I don't think you're missing anything. I tend to agree, because most of these trades are on and off in a 24-hour period. And, if you're talking about, let's say, selling 1 day volatility, I mean, there's a limit to how much anybody can lose in 1 day, right? I mean, you obviously have some crazy scenarios where the markets move 10% in 1 day, but how many times does that actually happen? Even if it moves, 4 or 5% in 1 day, you're probably not going to get, you're probably going to live to fight another day, right? So I think a lot of this stuff is on and off so quickly that it's not going to really impact the greater numbers. I mean, when I look at volatility, I look at the term structure anyways. I'm looking at multiple periods.
Yeah,
For the
so
most
the
part.
short-term.
Yeah. The zero DTE is like it might mess around with that very short-term vol a little bit, but not enough to say, hey, we're in contango, we're in backwardation. Like, I mean, the metrics that really matter on whether the market is concerned or not, I don't think that factors into it all that much. I mean, I'm sure that, there are people who see the flows on a regular basis that may have a different picture, but from my perspective, it doesn't seem to change the way I look at anything.
So smack me in the mouth if I'm saying this wrong, but it seems to me like you're saying zero DTE is almost a low risk options product. Is that right? Just because of the short-term nature of it?
Well, I mean, that all depends on how much you're doing, right? Sure.
Right.
You can
Everything's low risk if you're containing it.
Yeah, right. I mean, if I'm selling a one lot, if I'm selling a one lot SPX straddle every single day, it's relatively, even though it's an uncovered straddle, it's a naked straddle, right? How much am I going to lose in one day, particularly with the premium you're getting in? Probably not that much. Yes. But yeah, you start to do that in quantity, and people are, right. It amplifies the risk, of course. They tend to be pretty fairly priced for 1 or 2 days out. You start to see, like the research I've seen, Russell Rhodes has done a lot on this. You start to get 3, 4, 5 days out, and you're getting a little bit, the options tend to be a little overpriced. They might be worth selling, but it's pretty, whether if you make money long-term selling 1 or 2 day straddles, it's about break even over the course of the year. So they're pretty fairly priced last I've seen on the research.
Would you say that in zero DTEs, it's similar to, like, most of us that have been professional traders rarely just naked buy a call or a put, right? But we might buy a put spread or a call spread, or you might do a multi-legged option. But do you think in zero DTE, it's kind of coin toss as to whether you would sell them or buy them, or is it still, as a professional trader, say even in these particular instruments, I'd probably be a seller before I'd be a buyer?
I think it's gone to people mostly being sellers. I think when it started out, it was buyers. If they ever get around to doing zero DTE in equities, I could see that being more of a buying product, just because the idiosyncratic risk there. But I think with from what I've seen with the index products, which is all we have now for zero DTE, it's going to be mostly selling. Although I've heard, and again, I'm not in the institutional world anymore. I heard they make pretty good hedging instruments on a daily basis. So you might actually see some buying from the institutional side, right? On the hedging part, which is not something I would have thought, but apparently it allows the companies to more, the institutions to more accurately define their risk, right? By doing it every day instead of doing, let's say, a monthly hedge or something like that. So that was kind of interesting to me.
So when all three of us have been around a long, long time. And when options were at kind of their infantile stage, particularly in the equity options market, it was always kind of assumed puts would trade at a little bit of a premium because most people were motivated to buy puts to hedge their portfolio. Calls would trade at a discount because most people were motivated to sell puts as a part of a covered call strategy. First, before I move to the question, you agree with that? That was the talk from 25 years ago. That was basically how it was, right? Mm-hmm. Okay, now there's so much more. I mean, the growth of options, and I'm not even considering 0 days to expiration options, but options in general have exploded. Mm-hmm. Are those same patterns? Do they still exist? Do you still, when you look at puts versus look at call, is the skew still what it was before?
It is in the index products, right? Most of your symmetrical skew, right, where calls and puts are both expensive. I mean, that happens in single stocks. That may be a bit more extreme ever since the whole meme stock thing. Like, think GameStop, right, where you're actually sometimes seeing greater call skew, more expensive calls than puts, and some of those equity names, particularly when it's a cheaper stock, right? Because there's a limit to how far, can't go below 0, but it can go up to 500, right? We saw this with GameStop. So some of that may have changed a little bit, but indexes have mostly been the same. And I mean, because the fundamentals of volatility haven't changed. Volatility tends to go up as the market goes down, tends to go down as the market goes up. That happens, on on an index basis, that part really has never changed. So yes, your skew may change a little bit based on environmental impact and what's going on there, but for the most part, you're not going to see a whole lot of difference in more, puts be more expensive than calls on the index side. And yeah, the covered call thing that's definitely exploded, but there's plenty of people who sell puts too, right? That's also exploded, put selling.
Right.
So if it's pretty much just canceled out, and really it's just about volatility. Again, volatility going up when the market goes down and vice versa. That's why that skew exists. And as far as I know, that will never change, right? I don't see why fundamentally that will ever change.
Right. So I trade a lot of different things, and I trade options on most of those things. So like a couple of weeks ago when the Nancy Pelosi stock was breaking out of that wedge, I bought a call spread. I bought the 140, 160 call spread, and it's trading about 147 right now, whatever that is, because my licensing only allows me to talk about futures. So that's why I always kind of just alluded, but I trade all these things. By the way, I did not do any analysis on what strikes may be overpriced based on flows, things like that. I just didn't have time to at the time. I looked at that call spread and bought it. Is that silly? Would you always, if you're buying a call spread or put spread or selling a call spread or put spread, are you always going to try to get the best possible strike possible based on any sort of price anomaly?
Not really. And that's a great question because as an ex-market maker, yeah, I should, right? I should make all my decisions based on volatility. But sometimes I just want to do a directional trade and I don't care, right? Like as long as it's within reason, particularly where you're doing something like a call spread and you're able to, if a call spread is, if the volatility is expensive, then
it'll be in both. Yeah.
Yeah. Right. You're going to buy one, you're going to sell one. It's going to end up, yeah, I mean, when I'm doing something like a covered call or selling a put or a put spread, something like that, yes, volatility. I'm looking for overpriced volatility. But there are times when I make directional trades where I just want to make the trade because I have an opinion.
I don't want to feel like an idiot, right?
Yeah, no. Listen, I'm a terrible directional trader. I'm a great volatility trader. I'm a terrible directional trader because
it's funny sometimes talking to guys that are predominantly options. Options for me are an augmenter, right? I do trade them, but they're not strategy definers for me, so to speak. If I have an opinion on the market, I generally put it on in the outrights. But a lot of option guys will say, I'm just putting this on to see if I'm right. I don't really care. It's just such a funny thing because you guys are so used to just seeing if the math is right and making a decision unemotionally. Right. You don't have anything invested in. You're like, yeah, these are overvalued. So I sold them. These are undervalued. So I bought them, but I sold the overvalued puts against it. You guys are always doing sort of the math. It's really cool. I got a question from X. Okay. They came over from X. It's from EM. EM has a longer handle than that, but I'm just going to read it. Equity index inverse ETFs also on the decline. What do you think, Jay?
What does he mean by it? Decline in volume, decline in price? What?
I would assume that means decline in volume. I mean, inverse ETFs, of course, they're declining in price when the market's going higher, right? But I assume that the sort of popularity of them declining. And if you don't have an opinion, that's fine. It's just that's a question that came over X, and I want people to know that we're looking at that up there.
I'm assuming that the volume in inverse ETFs is pretty related to market concern, right? Like probably some sort of correlation between high volatility and volume and I have never done that.
You would seem that it would seem like the inverse ETFs were as much a hedging vehicle as anything, right? Maybe. I don't know. I never traded them.
Yeah, that would be my guess, right? If people were hedging and then now that the market's basically gone straight up and now settled in, what's the point of that as a hedge? So now it's just a directional trade and there's not a whole lot of fundamentals to suggest the market's going to go anywhere, at least through the holiday. Right now we're getting in the holiday period, right? So, Santa Claus rally, et cetera, so yeah, and that makes sense to me. That'd actually be an interesting regression to run on VIX levels versus inverse ETF volume. That you gave me an idea now.
Quick aside. I was short for 2 years. Was short a bunch of the Qs against what I considered the Mag 4. I didn't have the Nancy Pelosi stock, but I had a good representation of those. And the trade made quite a bit of money. And then about 6 months ago, we sell a building in Downers that we owned, an office building, and we had this huge capital gain. I'm like, shit. And then I look at my short, that's been it's been a great trade, but the short part of it, I had a huge capital loss. So I was like, oh, you know what? I'll take that off, replace it with options, which I did. And I love winning. This was what I'm saying. I had a nice capital loss there. And I had a question before, and I was about to, if someone wanted to, a basic strategy for you for volatility. So you look out of the term structure, whatever asset it is. What asset do you generally trade? Like if you're the first thing in the morning, what do you look at? What asset?
The VIX. Yeah.
The VIX. Okay. But if do you trade the VIX or do you just trade volatility?
I trade. I trade. I don't do much with VIX options. I trade the volatility ETF. So primarily SVIX, which is the short VIX, because I'm short vol is like my reason for being. Like I love shorting vol. Occasionally I'll hedge with
time
a long
decay.
vol.
Yeah.
Sorry.
Time decay is my best friend.
Yeah, no, yeah.
I
mean, or in the case of VIX, futures roll, right? I mean, it's such a powerful force, and VIX tends to be in contango. So yeah, I mean, that's like my bread and butter is just going short vol, like market vol. So yeah, SVIX, and then maybe if I want to hedge it, I can hedge it with options. I can hedge it with UVIX, or I can UVXY. I mean, that's the stuff I mostly look at. And then it might be stuff that I have for, in the products. I do several newsletter trading services type things. So then I'll look at the stuff I have on, for all my subscribers, which can be all different areas, a lot of single stocks and stuff like that.
Okay. So if someone wanted to, and I know we talked in our little promo about iron condors, and I hope it goes to this. So if someone who doesn't trade options, because I've coached, 30 different people who want to learn how to trade options. And I just walk them through. I say, we're going to buy a call spread, relatively tight call spread. This is what you can lose, what you bought it for. This is what you can make. Don't panic. Just watch it. Now you've learned how to trade options, and you don't learn until you lose a little bit of money on it, in my opinion. Anyway, let's say someone wants to trade non-directional just from volatility. They come in one day, the VIX is shot up to 23. They think that's absurdly high. How would you coach them through a strategy to take advantage of them believing it was absurdly high?
Yeah, that's awesome. I like that question because I think, again, there's a lot of moving parts. So there's multiple metrics you can look at, and it really depends on, how deep in the weeds you want to go. I mean, you can just look at VIX level.
So I'm just saying beginners. Yeah.
Yeah. If you're a VIX level and the long-term average is 20, say, oh, it's higher than long-term average. I think it's time to sell, but you want to look at that in context of what's going on. Right. I think that when it was above 20 and the main catalyst was the election, that was going to be an easy sell for me. Like I loaded up on short volatility because to me, the worst that can happen is there's a contested election and we have some marches, nothing, right? Where it's not going to explode into an armed conflict, most likely. Right. So my feeling was that no matter what, the worst case scenario is not going to be that bad, right? It's not going to be, it's not going to be the Fed hiking rates a percent or someone dropping a bomb on a unexpected country. Right. So something like that. So you definitely want to take into account why it's higher, and think about it just qualitatively, like, why is it high? Should it stay high? Is the market gonna, are we dealing with a major dislocation and something, so, I mean, that stuff is really, I think, important. But you can get into all kinds of stuff, what's the term structure look like? What's correlation look like? I mean, dispersion. I mean, there's a billion things you can look at if you really want to get down in the science, but I think just looking at the level and looking at why it's higher, it's almost enough to make those decisions.
Oh, Bobby, can I just jump in one thing real quick? Like if someone just off the top of your head, like an SPY or SPX, like an iron condor, will you walk the viewers, like what to sell that, to sell vol, why you would do that, how you would do that, how you make money before we get to the next question? Because I would like people to learn, because I would love everyone to use options, because I just think there's such a great way to mitigate risk. And that's how I sleep at night with options positions and not when I'm naked. But anyway.
Yeah. Oh, and yeah, absolutely. So in fact, I have a service that does iron condors. It's one of my favorites. So essentially you want to capture volatility risk premium. That's what you're taking advantage of, the fact that options are priced higher than what the market is actually, you think the market is actually going to move, right? That market moves at whatever, 0.5% a day, and you're selling options for that's pricing it for 1% a day, something like that. Obviously, just an example. The easiest way to do that is to sell straddles, but that's really dangerous, and you need a margin account, and you can sell strangles, which are further out.
By the way,
but
selling a straddle, by the way, guys, is selling a put and a call at the exact same price, usually kind of where the market is. Anyway,
right.
That's it.
Yeah, the straddles, you're at the money trade. If you want to do a little less risky, you can do, let's say, the out a little bit. That's called a strangle, right? But it's still uncovered. So the best way for the retail trader to take advantage of the volatility risk premium is doing a Condor, which is a put spread, an iron Condor, which is a put spread and a call spread that you're selling simultaneously. Reason being is that your risk is only what the width of your spreads. And that's all you need in terms of your margin account. If you're selling it's $100 index and you're selling the 95.90, the 105, 110, you can only lose on one side. The width is 5, right? $500 per contract is your risk minus what, let's say you collect a buck. So $400, you know exactly what your risk is. Worst case scenario, I've lost $400. You think about that. Well, it's only 100 compared to 400. Well, that's a 20% return on cash in what was probably a short period of time. So it's all about the risk of what you're putting up. And, so when I do those, I do them pretty wide, and I'm looking for, again, if I'm looking for high priced volatility. So I'll look at the indexes, most, QQQ, I'll do this in ETFs mostly, QQQ, SPY, and IWM. And usually every week, at least one of those has options that are priced higher than what it has been moving. And again, you want to know why is that happening? Well, could just be some economic numbers coming up and people are preparing. I'm not too worried about that. Election coming up, okay, I'm a little bit more worried about that. I'll be careful. But if it's just your standard monthly announcement type stuff, I think that's generally a good time to sell. I usually go out pretty far, so there's a nice big sweet spot where you can make money. You just want to stay in a range. You can move it a little bit if you're at all-time highs, all-time lows, stuff like that. But for the most part, you're looking for something you expect to be range bound. I do them a week at a time, so you don't have a whole lot going on. You don't have to worry about earnings as much when you're doing an index. So that's kind of my bread and butter there. It's pretty straightforward. It's just, mostly looking at volatility.
So it's interesting. People who trade outright stocks or commodities, whatever they do, tend to look at their reward to risk ratio, right? And they tend to not like to see it below 1-to-1, right? And that, of course, has to do with win percentage. But let's put that aside and say that you win at a rate of about 51%. You want to see your risk reward ratio to be at least like 1.2 to 1. I'm sorry, reward to risk. I always want to make sure I say that right. So for every dollar you risk, you'd make $120 in that scenario. In options, it's different. Option guys always talk about the return on investment rather than and I find that interesting. Can you kind of walk through why that's okay from a perspective of options? So for example, the example you gave, you made $100, you risk 400, but it's a 25% return on that 400, right? You got that 400 back because the trade worked, right? Is there that much higher of a win rate in those condors in the way that you do them?
Yeah, I'm expecting to win at an 80 to 85% clip. So if I'm below that, it's probably not going to work out. So you need to win a lot, but if the markets work like they normally work, that's going to happen, right? So, and the key is that when you have those moves that move against you, and it's going to happen, right? I mean, there's no way you're not going to have losing trades in that situation now and then. The key is if you're doing that only 15% of the time and you're controlling your risk, right? So if you make, if you make 100, I mean, you could, I'm just estimating, but if you make 185% of the time and you lose 415% of the time, if you do the math there, it should make money weekly. It should, it should work out to where your return is positive. If it's not, then you're not doing it. Then it's not the right strategy. So,
where I'm going with this is psychologically, does the option trader have to have sort of a different mindset? Because you could see an option trader going, I made money again. I'm so great at this. And all of a sudden that big loss comes in, wiping out 60, 70% of their gains. And they're sitting there going, fuck, I'm terrible at this. I better quit while I'm ahead. Is that a different mindset?
Before you answer, Jay, can I take a break for 1 second too? Because I want to say something to the audience too. In 5 seconds, we're going to be running a promo code at the bottom of the screen here for a 3-month free trial for Tradier and Tradier Pro. Tradier is an outstanding company. If you just hit the link that will be provided, you guys will be amazed. There is no obligation. 3 months free for Tradier Pro. Please support us here at Tradier. Anyway, Jay, back to you.
By the way, I didn't even tell you this. I use Tradier Pro, and it's awesome. So
look at this. This is a testimonial, an unpaid, unsolicited testimonial. Okay,
well,
so
I solicited him to come on the show, but we didn't pay him for that.
Yeah, no, that was not something I even thought about. But the option, their volatility stuff is great, and mapping out option trades and stuff. It's really, really well done.
Yeah, knowing the founders like we do, you would expect that to be the case.
Yeah, they're awesome.
So yeah, it is a difficult mindset. So I have to kind of train people, right? I'm like, you can't look at, it's, well, not you can. It's like you need to consider the long game in this, because it's not going to be your lottery ticket that I mean, if you're a long option trader, you're lucky to win 30%, right? And you're lucky. I mean, that's really good. If you're winning on 30% of your long, kind of a basic strategy, right? That you need those wins to be huge. You need them to be 500% winner. I mean, otherwise, so it's almost impossible to maintain over the long run, right? Now and then, like buying options to me it's a very situational thing. I do it, and again, just like we were talking about, I do it because I for some reason I have a directional opinion on something, which I don't that often, but if I do, I'll just use an option, right? So other than that, like when you're selling options, it's the long game. You have to get into the mindset that you're going to win a lot, but you can't get crushed when you have the losers. And it's hard for people. What happens though is that you get these long win streaks of like 15, 20 winners in a row. And it starts to feel, and even though that first loss hurts, you see, oh, well, that only ate into, a portion of my problem. And then you have another long win streak. And then, occasionally you'll have a couple losers in a row and it stinks. But when you look at it at the end of the year, I'm like, wow, I made 20%. I made 30%. You're probably not going to make 300%, right? I mean, but that's not, the whole thing is you're taking advantage of the edge. You're taking advantage of the volatility risk premium. It's statistical proven edge. If you're going to do that, there's not going to be an edge out there that you can do every single year that's going to give you 300% winners. I mean, whatever, not in the public markets anyways. So if you're looking,
you're one of the good guys then, because there are some options traders out there that try and sell products that say that is the case. So you're one of the good guys.
I mean, people will say whatever they say to sell product, and they'll have one big success and they'll extrapolate it out into the future. And, I mean, yes, that's, I make a huge point of, when the marketing people write that stuff, I'm like, do not make any promises about like, oh,
you're going to tell your story about your fund, right? That's why you want to.
No, actually, well, I could tell that story. Yeah, it would apply there as well, right? When I was on the investment committee of a fund of hedge funds, I was one of the initial investors and became a partner in the fund. We had 9 years without a loss, and now the caveat to that is our biggest year was 9.8%. We were set up to be like a bond, right? We weren't trying to knock it out of the park. We were just trying to not lose money. We figured this is a way to manage a ton of money, because when you have these investors and go, wow, these guys do 6 to 8 to 9% a year and they don't lose money, that's perfect, right? Well, the NFA would not allow us to use our actual track record until we had a losing year, because they said that implied that we couldn't have a losing year, even though like it was all over that we could. But no, the actual story I was going to tell is I got approached by an options quote unquote guru. I'm not going to call you that, Jay, because I consider it an insult, but he wanted me to sort of come and help augment his service. And he told me what he does. He charges a monthly fee, and then he brags all over social media. He does these way out of the money, like calls and puts. He tries to hit home runs, and he loses most of the time. When he wins big. So when he wins, he essentially would put that all over Twitter. Then he made a 600% return on this trade this month. He'd get a bunch of new people in. He would take their money, put it in his trading account, and that's the money he would trade. And he goes, and then I lose a lot the next couple of months, but nobody quits because they always want their money back. That's why we would never have a person like that on our shows, on any of our shows. And we have Jay on. So pay attention at the end when Jimmy tells you, or Jimmy asks you where you can find Jay. You guys should find Jay if you can.
Yeah,
So
it's
can
been
I,
a big
can I
deal.
ask a
for-
quick question?
Go ahead.
Yeah.
Yeah.
Do you consider yourself, when we're a seller of iron condors, is like, are you the people want to speculate, and the notion is that every option nowadays probably almost trades at a little bit of a premium, just because the speculators are all across the spectrum and they
Right.
tend to buy options. So you're like the insurance company. You're selling at a small premium, and the hopes are that it doesn't blow up. And if you insure 100 houses and one does, you probably one does blow up and you're burned down, whatever the hell the metaphor is. You get what I'm saying? You still make money. That's how you view this, correct?
Absolutely. I still, that analogy was the first one that I heard when I was taught about options. That you were talking about Kansas City. I started on the Kansas City Board of Trade and working for the exchange in the wheat futures pit, and people, there's options, didn't trade that much in Kansas City. They had to go to Chicago for that. But, we're saying, all right, well, options, think of it as insurance. And like, literally that's, 30 years ago, whatever, that was how it was explained to me. And that hasn't changed. I think, insurance companies make a lot of money by taking that premium and investing it, right? That's a big way that they make money as well. So, yes, you can even do that. You could take that a step further and you say, well, what are you doing with the premium? Are you able, depending if you have a margin account, are you taking that premium and are you putting into treasuries or something like that? That obviously can change your return profile as well. But yes, really you are the house and you are trying to take advantage of being the house. You are trying to use the edge that you have because you have an edge, and it's really all about risk management, right? It's all about, because you're going to win. It's all about protecting those losses when they do happen. And that's so much of what I try to push. It's just that if you're not focusing on risk management, then you're doing it wrong, right? That is so much about being a good options trader.
Yeah. So let me ask you about the VIX again. Sorry, I'm trying to get more people to join us on X by posting something. And I do have two more questions from M, but I don't really understand the question, so I'm not going to ask them yet. When you look at, there's been various volatility regimes as described by the VIX, right? So for example, if you go back to like 1997 through about 2003, you had a sort of I'm just guessing at the mean visually here, about 25 on the VIX, right? Then you go to about 04 to about 07, and it's down to about a 14, right? The mean. Then you go up through 08, 09, forget it. It's all over the place, right? During the financial crisis. But then since about 03, okay, we've had spikes, but the mean has been somewhere around, what would you say, 14, 15, maybe? Somewhere like that.
The longer term median is about 16. So we're talking about the mean of 20.
Okay.
But the median is more like 16. So
okay, so when you see today we have the VIX at about 14, that's not significant to you, right? Do you look at really low VIX levels and say there's something I can do here or no?
Absolutely. Volatility is one of those things where I don't know if you could say this on the high side, but on the low side, volatility is almost best to sell when it's low, right? Because of the nature of
low means lower.
Yeah, because stock don't have the same behavior, right? Volatility has specific behavior. It has clustering properties. It has mean reversion properties. But the mean reversion is lower, right? So when volatility mean reverts, it mean reverts lower. And then it has a clustering property where it tends to stay, looking at the day before is generally a pretty good indicator where it's going to be, right? So low volatility will stay low, right? High volatility will cluster at first and then will mean revert lower. But that's why, it used to be, before it got super popular, you used to have people would predict vol using Garch, right? This, kind of fancy model, though it used to be fancy, but that's exactly like Garch was designed for something that mean reverts, but also clusters. And it was like this really good way to prevent, and then everyone started using it. And now there's no edge in it anymore, but there's literally there's some perfect things for it before it got really popular. And it's because of those principles. So when volatility is low, that was to say when in 2017, and the VIX got down to almost like 9, right? It was 9 to 10.
Yeah.
Market was realizing like 4%. Right. So it was still way overpriced. And so it still made sense to sell it. So typically
Tell me what you mean by that statement. Market was realizing 4%. What do you mean by that?
The actual
Realized vol versus implied. Yeah.
Yeah, it was actually moving at what would be, like 4 or 5% for the whole year, right? It was moving so little that you were looking at it to maybe move up and down 5% during the year. And normally it's, whatever, 15 to 20 or 10 to 20. It just depends on the year. But let's say 10 to 15 on a kind of a normal, non-crazy year. You would expect 10 to 15, a little bit higher, 15 to 20, right? This was at 5. And so the VIX was at like 9 and it was still expensive. Right. So I mean, there's other things to look at, but yeah, the volatility does a good job of predicting, right? Like does a really good job of saying this is what the market's likely to do. And so nobody was selling VIX under 9 for the most part, because like, well, how much lower can it go? But it could, because the market was not moving. So that
was buying volatility in that time and getting my ass handed to me. I remember it well. But here, okay, I'm about to throw you a curveball, and this is sometimes I come up with crazy theories, and sometimes 1 out of every 100 of them is actually someone will say, that's interesting. And I'm curious if this is one. Okay, conventional wisdom, you just mentioned about investing the premium that you collect. And now we actually have an interest rate, which we didn't for much of our career. We didn't have an interest rate. So now the incentive would be for people watching. I'm not telling Jay this because he knows. If you're the market maker, you can go with a little tiny bit of a lower price because there's more incentive for you to sell it if you can take those proceeds and invest them in a 5.5%, overnight rate, whatever it is. I contended that when rates were held so low for so long, like a 10-year span of essentially zero rates across the board, that I thought there were so many damn strategies that were trying to get a return from selling options, like, buy gold, sell the GLD, calls against it, that I thought that function was actually depressing the price of options because rates were held so low for so long, which normally would be higher rates would depress them because it would incent market makers to sell it. Is there any validity to that theory I had? And had you ever thought of it before?
100%. There are actually, multiple like research papers that have I think since been written on that.
Oh, really? I gave him that idea. No, I didn't.
Most of it's around the index space. So there's probably work that could be done in some of the, like something like gold you're talking about. Yeah. Maybe that wasn't looked at as much, but I mean, the big case study there was in 2017, we were just talking about was, I don't know if you remember Harvest. They had like, I don't know, 15, 20 billion. And it was almost all in iron condors, right? They were doing these iron condors. They were doing it for, what's the bank? The Swiss bank, what am I thinking?
UBS.
Yeah, UBS, right. I don't know. I was drawing a blank there. Kept thinking of something else. But anyways, UBS, they were doing it for their clients, and Harvest was kind of the advisor for this. And I mean, they probably had, so it was something like 10 to 15 billion of iron condors that were being sold on SPX, and it was literally depressing the wings. So if you think of the volatility curve, so the out of the money puts and calls were being depressed because of this, and there was nothing going on in 2017. Now they got sued pretty much out of existence because 2018 happened and things started moving, and everyone got hammered on these iron condors.
Was that the apology guy? Was that the guy who filmed the YouTube video apologizing to everybody?
That was that was a different one. That was similar. I mean, it was also with options, but that was natural gas, which is really going to wipe you. Be careful about selling vol and natural gas, by the way. But yeah, no, that was another one. And that was an interesting case study. There's a lot of interesting case studies around that time. This is also when you had Volmageddon in February 2018, where if you were short vol for that February and that it blew up XIV. And I mean, there was, around this time, there's all kinds of crazy stuff that happened, but 100%, even today, I would say that there is some suppression because the amount of systematic overselling, more on the covered call side than potentially potentially puts as well. But pension funds are systematic sellers of covered calls, and it makes sense for them because they have obligations to pay out. So the cash flow for them is almost as important, and also the steady returns, right? They don't care if they only make 5% on the upside of SPX instead of 8%, because they're looking for steady returns and they're looking for cash flow so they can pay out their obligations to pensions, right? So pensions love that sort of thing. And, when you're talking about pensions, you're talking about, I don't know if the number's trillions, might be billions anyways, of option selling happening in some of these liquid products. So 100%, it suppresses volatility. Now, does it suppress volatility when things go crazy? Probably not to the same extent, but it could potentially exacerbate it, right? It might not give you the same readings that you might have had during, really slow periods. If that there's a lot that could be said there, but yeah, it's definitely an interesting topic, I think.
I'm not really sure, EM, what you're trying to say here. So I'm just going to move on because I don't understand the questions. They're on Twitter, Jimmy. They're on X.
Okay.
I'd love to ask the question. One was, what do you think about Bitcoin? I mean, we can all chime in on that if you want.
I love that
question. Go ahead. So what do you guys think about Bitcoin? We'll start with Jay.
What I found.
Start with Jay. I thought you said Jim.
Yeah,
go,
Jay. Jim. Yeah. What's interesting about to me about Bitcoin, I have a friend who's a market maker in Bitcoin options over in Amsterdam, and he was saying that it's become, people are underestimating the institutional allocation to it. And volatility has gone down, which tends to mean, people are buying on the option side. And it is now I thought it was maybe just a momentum trend following thing, but I think there might be an actual, it's a liquid instrument that provides a different correlation, right? So it's getting to the point where people are buying it, whether you agree with it or not. And I'm not a fan of crypto at all, but if it trades and it's liquid and it provides a different correlation that you can put in your portfolio, then I don't know how you argue that, right? Like I don't really play in that area, but it's an asset class now, whether we want it to be or not.
Jimmy?
So most of you people who are watching this know that I buy Bitcoin and Solana and Ethereum every Wednesday. It's just on a regular scheduled purchase that I usually don't trade much around it. However, there's some things that I do trade around. 2 years ago, BlackRock announces they're getting into the space. I will follow BlackRock into any trade, not because I love them and respect them, just because they're BlackRock. And they were the epitome at the time of institutional broadening of adoption, increasing their footprint in the space. I thought it was a huge deal. Now you got companies even like CME offering the 150th, nano, whatever it's called, the BFF, which is a great product, and it filters down to retail space. And then you have the only institution that is secondary to BlackRock on the planet. Its close second is the U.S. government. Yes, that's a joke, but the U.S. government now getting into to Bitcoin and talking about the potential for a strategic Bitcoin reserve. This is groundbreaking shit. So to be surprised at this move higher, it means that we're all being silly. And I don't give a shit what Bitcoin even is. I don't care to even know. I spoke at a Bitcoin conference like 7 months ago. And one of the first things I said is I don't care what Bitcoin is. And you guys all think, the people, not YouTube, but the people there, you guys all think Bitcoin is the solution for everything. I'm about 10% sure that you're right. And that's enough for me to be on board with you guys. And here's why. And then I went about, stewardship of fiat currency, and they seem to like the speech. Does that all make sense to you, Jay?
Yeah, I mean, I'm pretty much the same way. I have almost no opinion. If I did have an opinion, it would be negative on it becoming an important part of our currency system, but it doesn't matter, right? To me,
but even with the U.S. government now talking about it?
Well, can I address that actually? Let me address that, because the thing that, Jay triggered something in me when he said, it has a different correlation, which I agree with 100%. The thing that's been bothering me about Bitcoin prior to this current move is it still was positively correlated to NASDAQ when the NASDAQ was lower, right? That's not happening specifically today. NASDAQ is down about 1/3%. Bitcoin is up. Let's see, where is it right now? It's up about 1.16%. So it's off its highs by a substantial amount. If Bitcoin continues to correlate to the downside with the NASDAQ, then I don't like it as a buy and hold. I still like it as a tradable asset, because one of its qualities, in my view, is it being a high beta store of value, right? That's where it has real value, because still it's not a use case thing. It's just not.
Do you think it ever will be?
Yeah, I do think it will be. I do. I think it's the winner of the crypto space, unless our Department of General Efficiency, Doge, somehow says that Doge is a part of their efficiency. That would be sort of the alternative there. But I do think it will be. This move up into, 100,000 is self-fulfilling to me here. But what's the mechanism? Same way, Jay, you don't know this. We had Vivek Ramaswamy on our other show about a year and a half while he was running for president, right? 2023, when he first announced his campaign. And I flat out asked him, and Jim asked in different subjects in the same way. I said, you want to shut down the Department of Education. What's the mechanism? And he explained it. I'm not sure there's a mechanism to add Bitcoin to the strategic reserve of the Treasury. Maybe it's just as simple as, hey, we're going to buy Bitcoin.
Yeah, that's what I would have thought.
I don't know. If you look at the holdings of Bitcoin, and some 85% are in the hands of like 5 people. Maybe they're not people, but 5 entities, right? So like, how much can you buy? Like, how much can you buy to actually have that reserve? I don't know. So it really depends now. It's one of those things. It's like, how does it play out? Is this move we're seeing in Bitcoin now the same as the one we saw in the stock market? We're like, if everything happens, this is the right trade. And then if it doesn't, what's the right trade from there? I don't know. That's my short version of it. I've got a much longer version. Having said that, I just got out of some longs yesterday in Bitcoin, some trading longs that I had on, which I've lost a little money on that today. I've left a little money on the table.
Left a little money on the table. That's different than losing money.
I didn't lose any money at all. But I do have an options question before Jim asks his last one. I have a theory, and you guys can rip apart the theory if you want. Call me a dumbass. But the communications sector has a reckoning coming, right, with this new administration. And obviously, Twitter, X, is no longer public. So when you're looking at the communications sector, you're looking at Google, Meta, Disney, Verizon, Comcast. There's more. Netflix, Spotify, AT&T, right?
Why those other ones? I see Google because he might view them as the enemy, but why would those other ones take a hit?
Well, Meta is obvious, right?
Oh, Meta's obvious, right? Yeah.
Meta's obvious, right? Disney is obvious if you looked at them as sort of a negative to the side that's now won.
Yeah.
Right. Spotify should be okay, but if the entire sector goes down, you can hold on to Spotify. I don't know. It's like a sinking ship, sinks all boats. So I look at this and I say, okay, volatility is sort of normalizing, right? And it leads me to the idea of a put spread. But I feel like the two of you may have more efficient ways to play that out without taking the risk, because I think this is a bull market. So if I wanted to short, what's the sector? XLC maybe? XLC, I think, is the spider communications sector. What would be an approach to look at? I'm not asking for a trade here.
Jay?
What do you want to eat?
Yeah, I mean, you could do, because my mind goes to a little bit more complicated things, but you could do kind of, you can almost do a collar, right? Where, if you want to participate in some of the upside, you're still selling.
Explain what a collar is. I know a lot of people know.
So, let's say let's just use XLC. So you load up on XLC, and you sell, you sell a call above that. Let's say 5%.
97.20 now. So we'll make
97.20. So whatever 10% is that. So let's just say 102 or whatever. You sell a 102 call, you collect that premium. And then this is where you could get creative, right? If you wanted to be just like, like the JP Morgan hedged equity, you could buy a put spread, right? Protect some downside, sharing some upside, would basically do that for zero cost. But you could do it almost as like a ratio, right? Where you're selling a call, and then maybe you're on your put spread, you're buying more puts than you sell, so that there's some downside. You could create the math there to where it works out, where, if it really drops lower, you make money. If it goes down a bit, you kind of, maybe you lose a little, you break even. If it goes up, you make a little bit of money, right? You can set that profile with ratios. And that's what I love about options, right? You can define kind of whatever you want. And that's the sort of situation where, you could do something that gave you a I don't know if the black swan is the right word, but if something major happens and all of a sudden you're right, that stuff gets hammered, you're doing fine. If it goes down slow, maybe you lose a little money, because it stays where it is, goes up, you do all right. So like, that's what's beautiful. I mean, there's never ending amount of things you could do with options. And if you want to get creative, or you could do the individual component, you could do individual components where you're doing cover calls on those, and then you could buy a put spread in XLC to hedge against that. So there's all kinds of ways of things you could do with correlations and stuff. So I don't know, that would be a fun project to kind of put together, right? When you spreadsheet that out.
What Jay just said, options are a disease. Like I am so addicted to trading options that I can see myself as a 92-year-old man, in between feedings at the nursing home, putting on my option structure for the day. Cause I love the math. It's like some people do Sudoku, some people do that. Like I love trying to build a better mousetrap. And by the way, wanting to build a better mousetrap has not always led me to great spots. There was a couple of years. I remember one time my partner said, yeah, I think you're perfectly edged in either direction. No matter where the market goes, you'll lose a little bit of money. And it's like, shit, that's not what I wanted. Right. So, but anyway, let's call it here. Is that okay?
Yeah, it's time.
Okay. And by the way, you could mention Google before. By the way, I don't think Google's going anywhere because I think they're the CIA, just to be clear. And by the way, before y'all say I'm a tinfoil wearing crazy man, I can back that argument up pretty damn well if you want to take it offline. Anyway, that is Jay Soloff. Jay, tell them where they can find you. It's important that you guys find him because he's a great options teacher.
You can work for a couple companies. InvestorsAlley.com is one. You can find me there. Do a lot of ETF option stuff. And netpicks.com is where my Iron Condor product is. So either of those places you can find me, or you can just Google me. I show up all over the place. So
awesome. I will say I've enjoyed this conversation too, but I root against the Chiefs now, not as much as I root against the Packers, just because they've had too much riches over the last 6 or 7 years. I've reached peak Chiefs. Is that okay? Do you forgive me for that?
I understand completely. I had reached peak Patriots, right? For quite a while.
Yes, exactly. Okay, it's the same sort of thing. Yeah.
Yeah. The Chiefs are the Patriots of the
Chiefs are now the Patriots. Yeah.
Look at what Todd said there.
Thank you, Todd. Google is the CIA. Of course it's the CIA. If we were the CIA and we were the head management and we were having a meeting and we're like, shit, we're supposed to be gathering intelligence, but that company does it way better than us. Why the hell wouldn't we take them over or start them in the first place? Who knows? Of course we would. Anyway, before things get too crazier than that, let's call it a day. This is Tradier, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. That's Jay Soloff. Thank you guys. None of this works without the support that you guys have given us. And this has been a couple of years now that we've been doing both our podcasts. It is amazing. The DMs, the retweets, the positive feedback you give us, it's fantastic. Remember Bobby and I's mission. We were somewhat cast away by legacy media because we wouldn't shut up or we wouldn't parrot the opinions they kept telling us to give. By the way, proud as hell of that. Wouldn't have changed a thing. We want to create platforms where we can say exactly what we want. We don't care about being wrong on an opinion. We want to give you an honest opinion. Well, we care a little bit about being wrong. Hopefully you guys like it. And thank you guys for being part of it. This has been the Trader's Edge. Thanks.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.